All right, welcome, ladies and gentlemen. I'm delighted to welcome our first presenter to the stage. Avi Gilbert is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by him, a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch.com, Forbes, and Seeking Alpha. Avi, I'm going to stop sharing my screen and pass it over to you when you're ready.
Great. Can you see me?
Just go ahead and click the share screen button at the bottom.
Let's see. Hold on a second. Why isn't it coming up? Oh, wait a second. There we go. Okay, I think I got it. Share screen.
Yep.
And there we go. Can you see me?
Yep, everything looks great. Stage is yours.
Great. Okay. Good morning, everybody. And thank you for joining us at the Money Show and joining me at my presentation. We are going to be talking about where I foresee the stock market heading for the rest of 2021 and beyond. So let's get into it. And let me start by saying, for those of you that haven't followed me in the past, I'm what you call an Elliottician. What does that mean? Well, what that means is that I utilize a method of analysis that many view as very, very complex or esoteric. It's called Elliott Wave analysis. And back in the 1930s, a gentleman named Ralph Nelson Elliott identified that the market was actually fractal in nature and it was patterned. What does it mean by being fractal in nature? It means the various segments of the market are variably self-similar at all degrees of trend. Well, what does that really mean? Well, it really means that Elliott found out that the market moves up in 5 waves and moves in a primary trend within 5 waves and moves within a corrective trend within 3 waves. Waves 1, 3, and 5 are what I call impulsive waves, meaning 1, 3, and 5 themselves are made up of 5 smaller degree waves. And waves 2 and 4 are corrective waves, and they're made up of 3 smaller degree waves. So, and you could take this going up in time frame, down in time frame, and you will see it throughout all the time frames. And that's what we mean by variably self-similar. Now, Elliott identified that this really was not because it was the markets are driven by some form of news or events. Rather, Elliott theorized that it was really due to what he called, nature's law. What is nature's law? Well, if you actually go and look at how the human body is made, if you look at plants, trees, anything throughout nature, you will notice that there is a similar ratio running throughout everything in creation. And everything in creation is basically guided by the Fibonacci ratio, the golden mean, however you want to call it, but it all relates back to the 0.618 ratio. For example, if you look at your body and you divide your body right at your belly button, you'll notice that 0.382 of your body is over your belly button, whereas 0.618 is below your belly button. I mean, there are many instances. For example, on your hand, you have 5 fingers, and not all, but 4 of them have 3 segments to it on your fingers. I mean, there are a lot of this 5-3 relationships, the 0.618 relationships that we see throughout all of nature. We see it in the human DNA. The human DNA has ratios that are based upon that same 618 relationship. And over the last 20-30 years, what has been most interesting is that many studies have actually, many psychological studies have actually come down that actually show that human thinking actually divides within that same natural ratio, within that same 0.618 ratio. Many studies have been conducted that show this, and it shows that not only is nature created within that same Fibonacci structure, but so is our thought process. when you have to make certain decisions, believe it or not, you are driven towards those Fibonacci ratios when you actually think and make decisions, which is oddly enough why it's so prevalent in our stock market, because in mass, all of society is driven by that same natural law. As a society, we're driven by the same natural law. And that's why Elliott was able to identify these structures in the market as continually recurring over and over and over again. These relationships are seen over and over and over again throughout not only time, but throughout the entire market price structure. And that is what I analyze when I look at price structure. I'm looking at not just Elliott's 5-wave structure, but I'm also looking at the relationships between each of the waves within that structure. So in order to come up with a really solid analysis, I have to be able to do the analysis at the larger degree and take it all the way down through the smaller degree. And as long as everything lines up, I have a really solid wave count. Now, what you're looking at is a 100-year wave count on the S&P 500 that was done by Garrett Patton. He's one of our analysts at Elliott Wave Trader. And Garrett was kind enough to put this long-term chart together for us. And what it shows is where we are in the longer degree trend. And I think important for everybody to really focus upon, so you get an idea of where I think we're headed over the next, believe it or not, decade or two. So when I look back at, if you look back in the 1930s, you can see, the Wall Street crash of 1929. That was the top of what we consider a blow off top for that larger degree, wave 1 in paren. And then the stock market crash, which ushered in the Great Depression, was wave 2. Now, at the time, and then we had this rally off here, and then we stagnated during World War II. At the time, in the middle of World War II, Ralph Nelson Elliott came out with probably the most incredible market prognostication I have ever seen in my life. He basically said that he is now expecting an 70 or 80 or 90-year bull market to develop. And as you can see, I think he nailed it. I mean, can you imagine being in the middle of World War II as it's raging around you? The world is at war.
Hey, Ari, Avi,
can you hear me?
yeah, are you changing the slides as you're speaking right now? The audience
No. I'm still on the same slide.
Okay, because the audience was just getting a little confused if you were referring to different slides. You're still on the same chart, is that correct?
I am still on the same chart, the 100-year index.
Okay, all right, thank you very much.
So just so you know, guys, there are going to be 2 things you're going to be seeing during this presentation. You're going to see this 100-year index, and then you're going to see my charts from TradeStation. So that's really all you're going to see. I'm doing this straight off of my charts, except I'm giving you a preliminary background utilizing this 100-year perspective. So imagine being in the middle of World War II, and somebody says to you, "Yeah, we're about to start a 70 or 80-year bull market." I mean, you're going to look at that person like they're crazy. In my opinion, that was the best market call I've ever seen in my life.
Hey, Avi, I apologize for interrupting. They're not seeing the 100-year chart.
They're not seeing the 100-year chart.
Yes. Have you shared the right screen here? Because I've got the audience.
Okay, you know what? Let me stop share, and I'll start sharing again. And this happened last time also. Can they see it now?
There we go. That looks correct.
Okay, sorry about that, guys. I don't know why, but every time I've done these presentations, from going from chart to chart, it always causes a problem. I don't know why. Okay, so again, right here, you can see the top of the wave 1 in paren, and then followed by, I'm looking at the 1930s on this chart, so it's closer to the left side of the chart, and you could see the wave 2 crash. And it was over here back in the mid 1940s that Elliott came out and said, we're about to see a 70 or 80-year bull market. And that's what we got. Now, here's the thing. The wave 2 bottom at the Great Depression in that paren Roman numeral 2, I want you to, what comes after 2? You have 1, then you have 2. What comes after 2? Well, if you look to the top right of the chart, there is your 3. See that 3, Roman numeral 3 paren on the top right of the chart. That is where I believe we are heading over the next couple of years. And for me, I mean, this chart has been so accurate for us for many, many years. Many people ask me, well, how did I know that we were going to rally to over 4,000 from that 2,200? It was impossible to even think. If you remember back in March of 2020, everybody was freaking out. And I got to be honest with you, I understand why. I mean, I was literally working almost 24-hour days, and it wasn't mostly because of analysis. A lot of the work I was doing was actually more of the psychological side to try to calm people down, to make them non-emotionally recognize where we are in the market. And my expectation was once we dropped to that 2,200, which was the ideal target for this bigger fourth wave that I'll show you in a minute. But my expectation was this chart did not tell us we were done yet. This chart told me we had a minimum of 4,000 to go, with the strong potential to go up to 6,000 on the S&P 500. So if you ask me, why was I so sure at 2,200 that we are about to see a major rally? I will tell you it is predominantly because of this chart, which told us we are not yet done. So let's move off of this chart. And before I move off the chart, I want to show you, once we finish off the paren Roman numeral 3. What comes after 3, folks? And I got to tell you, that's the great part of my job. I never have to count past 5. So what comes after 3? 4. Well, remember, within a 5-wave structure, wave 2 and wave 4 are corrective structures. Well, wave 2 presented us with the Great Depression. What's wave 4 going to present us? I think wave 4 is going to present us a lot of pain. It could even usher in what some may view as the Greater Depression. I don't know. This is a prognostication. I don't know what they're going to call it. I don't know what's going to cause it. I don't know what it's going to be blamed upon. All I know is we are approaching, over the next couple of years, we are approaching a major market topping point. So let's move into my larger degree charts. Now, can you guys see my TradeStation charts now? I've moved into my TradeStation chart. Can you see it?
We cannot see it yet. We're still looking at the 100-year.
Okay. Well, when you're looking at the 100-year, I want you to remember where that paren 3 is. And I'm going to stop share and start again to try and reset this. Can you now see my chart?
Yes. Yep. We can see your chart now.
Great. Remember that wave 3 paren that you saw on the 100-year chart? That's right here. Remember
Avi, is there any way to zoom in on that chart at all?
Well, I'm using this just for the bigger picture. We're going to be going down to the daily and then 60-minute after.
Fantastic. Thank you.
So we're going to drill down so you guys have a better understanding of where we are now and where I expect us to go. Now, that big 3 is where I'm expecting us to go over the next couple of years. And if you see, that's the big wave 4. And it potentially can take us as deep as now, theoretically, this wave 4 should take us back to one of 2 places. Either the wave 4 of one lesser degree, the sign of the devil, 666, sorry, or the second wave bottom of an extended 5th wave. I can consider this an extended 5th wave, so that's why my minimum target really is about 1,000 on the S&P 500. So when I told you that, you know, we could see a lot of pain, imagine, I mean, remember how bad it was when we went through this? Can you imagine what a 10 to 20 year bear market can now do to us and take us back from 6,000 back as low as 1,000, assuming we don't even get the 666 again? But even to 1,000, imagine what that could do to us. Now, my alternative count, now, mind you, many people deride me because I have alternative counts. I want you to understand very clearly what alternative counts do. Alternative counts are for risk management purposes. An alternative count tells you, you have to now switch gears. Your primary expectation was wrong. And it tells you relatively early in the cycle that that's the case. And that's the nice thing about the methodology. If you're doing it properly, you're not going to be on the wrong side of the market. If you are on the wrong side of the market, it will not be for long. We course adjust very rapidly. Now, you can also consider an alternative count similar to when a general goes into battle. He has its contingency plan. He doesn't have just one plan. He has its contingency plan. And that's just the way armies go to battle. We do the same thing in the market, and we use it for risk management purposes. We don't like being on the wrong side of the market, so we do not stay on the wrong side of the market for long. That is the benefit of having an alternative count. Now, what is my alternative count in this instance? Well, my alternative count is that this wave 5 of 3 turns into a much bigger extension. But I'm not going to know that until we get to at least the 2000 region. We're going to need to see a big A, B, C correction, at least into the 2000 region, before I'm able to determine whether or not we're ready to go to 15,000 on the SPX before we have that bigger wave 4. I'm not going to know that, and it's going to take some time. So minimally, folks, I'm looking for us to get back down towards the 2000 region from the 6,000. And that, my friends, is, in my opinion, the best case scenario that we're looking at. So yes, I said I'm looking for a lot of pain once we complete this, and I was not kidding. But let's now take a look at how much more do we have until we get to that top. Well, here's, oops, sorry, that's my 60-minute. Bear with me. Go to the daily. Here's the daily. Now, I'm not going to go into the depths of our Fibonacci pinball system on Elliott wave analysis because it does get quite complex. So what I'm going to tell you is I'm looking at this pretty simply. You see that market pivot. Normally, when you rally up, and I was looking for a rally to 4440 to 4600, which is basically where we topped out. And from there, I was looking for us to come back down and test the market pivot from above. And that is exactly what we're doing. Remember, I told you I'm expecting somewhere around a 200 or 300 point pullback. For those that have been following my analysis, I've been looking for a 200 to 300 point pullback. And that pullback is what I was looking for to take us back into our market pivot. Now, interestingly, I put this market pivot out many months ago. And it's interesting that now the 200 DMA has now moved into my market, my major market pivot. When we break out through the market pivot, that market pivot then becomes our major support in a bull market. And that is where we are. We are now testing this major support. A successful test of this major support, which is what I am expecting, will now project us minimally up to the 4,900 region next. So where is my overall micro support? Now, before I go into the smaller degree on that, now, by the way, I'm probably going to be done. I'm guesstimating somewhere around 10:30. I probably won't be talking for maybe another 10 minutes. And I'm going to leave the last 15, 20 minutes to questions, because oftentimes the questions lead to a lot more information that I'm able to convey myself. So I'm going to open the floor to questions probably in about 10 minutes time, but let me finish through the presentation and I'm going to tell you what I'm seeing further. Now, when I look at the daily chart, the other thing that I look at from a technical standpoint, if you look at the MACD on this daily chart, I have highlighted a support region that has provided the market support from which we have seen rallies of hundreds of points. The last time we hit this, we had a 1,300 point rally the last time we hit this region. And if you take note, the market technically is even now more oversold than when it was when we began that 1,300 point rally. Take a look here. This one was, of course, we can go deeper into it as we saw here. But take note, whenever you get back down into this support region, it tells you do not remain too bearish. the market can prepare us for a turn up. And that turn up, when you get oversold this strongly, the turn up usually is quite strong. So I want everybody to recognize where we reside. Not only are we in our major pivot for the big picture, we are in our major market pivot, which represents support, which the 200 DMA has now moved into, all the things that people are looking at for support. We are now at major market support. And the technicals are telling us we are now so oversold that we can support rallies that could be as much as 1,300 points. Right now, I'm only expecting a 600-point rally. As it develops, if it's going to be more, I'm sure we'll be able to see it as it goes. Right now, I'm expecting a 600-point rally from where we are today. Your risk is down to maybe a little bit below 4,100, but minimally, I'm looking up to 4,900 as my minimal target. Outside chance we could get up to 5,100 plus. Right now, I'm looking to 4,900 region from our major market support. And that is where we reside today with these oversold conditions. So that is my expectation as we look out into, everybody looks for the holiday rally. To me, we're setting it up. That is what this is looking like to me. We are setting it up. So let's look at the 60-minute chart. Okay, let's go a little bit deeper. Now I'm going to go a little bit more into our Fibonacci pinball structure, and it'll explain why I have been looking at the market as I have, if you have been reading my analysis, both publicly and on our sites. We base our entire analysis on the 5-wave structure. And once waves 1 and 2 are in place, then that gives us a path for the rest of waves 3, 4, and 5. How did I know that the market was going to go to 4,440 to 4,600 before we were going to see a 200 or 300 point pullback? Excuse me. Well, that was because I've got a 1-2 structure here. And that 1-2 structure gives us Fibonacci projections. Remember, I said that a 5-wave structure itself, waves 1 through 5, waves 1, 3, and 5 within that 5-wave structure also have to be comprised of 5-wave structures. Well, if I'm looking at a 5-wave structure for 1, 2, and then I'm looking for 3, 4, 5, I'm looking at wave 3. That's my ideal target for wave 3. So that means I know that all of wave 3 has to break down into a 5-wave structure. So let's look at it. Waves 1 and 2 are here. I got wave 1, 2 of the bigger next degree moving. Now, this wave 3, remember, this wave 3 is what we're tracking. This wave 3 of this wave 3 usually targets the 1.0 to the 1,236 extension of this 1.2. Where does that reside? 4,440 to 4,600. That is why I have been saying repeatedly, I expect the market to go up to 4,440 to 4,600 before we get a 200 to 300 point pullback that tests our major market pivot. We topped at about 45.50 and we are now getting that pullback into our major market pivot. And we are getting it with some really nice divergence. From a technical standpoint, we're getting some really nice divergence down here at these lows. Ultimately, my expectation, again, is that this major market pivot is going to hold. You really have to break down below 40.50 to make me concerned about the upside. But here's the thing, folks. The deeper we go into this support, the more likely it becomes that we go beyond 4,900 on the next rally. I'm going to say that again. The deeper we go into this major market pivot, in other words, if we actually get down to the bottom of this major market pivot around 4,100, it will open the door for us to not just to go to 4,900. That is the scenario where we could go up to 5,100 plus. That's why for now, My expectation is we're going to hold the upper portion of this major market pivot. That is the 4165 region to the 4270 region on the SPX. On the SPX, so far, we have been holding that region. And that's my expectation for now. But if we should go beyond that, if we should go deeper into this pivot, I'm looking higher into 2022 before the next bigger pullback takes shape. Ultimately, remember, the ideal target zone for this 5-wave structure off the March 2020 low is going to be 5,500 to 6,000. I want to see us getting to 6,000, but I will tell you, I'm going to tell you this here. Let me show you the daily chart. Personally, once we get up to the 5,500 region, folks, I'm personally be going to a lot of cash. And because, you know, at best, I'm going to be expecting a big pullback from there and maybe a double top, maybe a higher high, could be a blow off top. I don't know yet. There's certain things I just cannot know. But when we get to this point, guys, the risk rises significantly that a major market top will be hitting. So when we get up into this region, folks, I'm personally probably going to a significant cash position. I will trade this move back up, but for me, I will probably, and I'll be taking my family to a significant cash position. Let me show you the 5-minute chart just to show you what I'm seeing right now. You know, I'm looking for, you know, the upper end of our support to hold. This is my fourth wave target. It looks like we're trying to maybe get a little triangle down here before we head down into the target. Ultimately, folks, again, it says the same thing. I need to see support hold. Once that support holds, I'm looking at 4,900. How will I know when the next major trend has begun? Well, that's what I keep saying over and over again to our subscribers. Once we hold this support, I need to see a 5-wave structure come into this region, which is probably going to be below 4,400. I want to see a corrective wave 2 pullback. And then when we rally over whatever high this makes, that is your signal that we are likely back into the rally phase and going to 4,900. But I'm going to tell you, don't assume it's going to be a straight line. This 1-2 is only of a bigger 1-2. This 1-2 will still give you another pullback, probably take you back towards that 4,400 again. So there's going to be a number of buying opportunities if you're trying to trade up to the 4,900 region. If you look at the 60-minute chart, you could see the bigger 1-2 that I'm presenting. So I think we're going to go back up towards the prior highs. So if you see a bigger 5-wave rally going back up towards the prior highs, the pullback thereafter will probably be your last opportunity to be buying a pullback before this market begins its rally towards 4,900. Okay. Overall, I'm going to tell you, where is my expectation now? My expectation is I think we bottom in our market pivot, and I think we head up to 4,900 into the early part of 2022. Depending on where we probably the first quarter is my guesstimate. Depending on where we bottom in this pivot is going to tell me how high we go. For now, I'm expecting us to bottom out in the top half of the pivot. Therefore, my expectation is the 4,900 region is next. Should we break down a little bit below that, we could go to the next Fibonacci level at 5163 after that. So, but for now, I think we're going to go to the 4,900 region, and from there we could see yet another bigger pullback before we head even higher. Ultimately, guys, you know, I think what I'm really saying is the biggest part of this rally off of March 2020 is really done. I mean, we now we're done with the biggest part of the rally. We've doubled. At this point, I look at us as going from, you know, the 4,000 to 4,100 to the 4,300 region up to 5,500 to 6,000. So the greater part of this rally is done, but there's still going to be plenty of opportunity for further gains as we look out over the next couple of years. My expectation is I don't think we're going to top until, I don't know, maybe 2023, maybe it pushes it out till early 2024. But that is my general expectation as to where I think we're going to top out. And at that point, I fear we're in for a lot of pain. So that's my spiel. I am willing to take your questions now, but I'm going to ask you, please keep it to the overall equity markets. I'm not going to discuss individual stocks, and let's stay away from gold and silver, because my view of markets is each chart trades on its own. Now, if you're in this expecting that once we're done, you can go into gold and silver, I got to tell you, that is not always the right thing to do. There have been times where gold has gone up with the market. There's been time that gold has gone down with the market. And there's been time where it has gone opposite to the market. Do not automatically assume that just because the market is topping, that gold is going to be your safe haven. It is an absolute misnomer. And anybody that says that has never bothered to look at market history. So we're going to look at, where does gold reside once we get to our top, and then we can make some determinations as to whether gold can be a safe haven or not. As it stands right now, I think there's a good chance that gold may come down initially with the initial move down in the market off those highs. So I'm waiting until probably about 2022 before I'm going to make any further determinations. But please, I beg of you, do not assume that gold is going to be your safe haven. Anybody that did so back in 2008 and 2009 saw their gold holdings drop by over, I think it was a little over 30% while the market was crashing. It really did not offer any safe haven status. So at this point, folks, I'll open the door for questions.
Thanks so much, Avi. Can you hear me okay?
I can hear you great.
So many questions, so many different talking points. Excellent presentation as usual. Let's jump to our first one. In your opinion, what is the best sector, perhaps, or place to hide out over the next couple of years to capture some gains?
I'll be honest with you. I think IWM is going to potentially outperform on the next run. So two places that I've been looking at right now is the IWM, and we're also stalking an entry, full entry now on the EEM as well. I'm liking emerging markets down here too. It looks like both are bottoming.
Fantastic. Next question is, how do you calculate time targets for wave 3 and 5?
See, that's a great question. And I can't tell you how much research I have done into market timing per se. There are cycles analysts, there's Fibonacci ratios and timing and so on and so forth. There's moon cycles and other types of astrology cycles. I have looked at, and I've done in-depth work into everything. I have found nothing that is greater than 50% accuracy when it comes to a quote unquote timing cycle. So when I give you a timing perspective, it is generally a guesstimate. I will never tell you this is it. I've done analysis. I put together analysis on Elliott Wave Trader where I used about 90 years worth of timing analysis to come up with approximately the 2022-2023 timeframe for a major market top. And that's utilizing Fibonacci mathematics. Now, within that 90-year timeframe, that 2022-2023 timeframe also is, as they play with Fibonacci, it's also plus or minus 1 or 2. So it could easily go as long as 2024. I know it's not now because I don't have the structure for a market top yet. But when anybody tries to tell you about timing, my eyes glaze over, because as I've asked every cycles analyst I know, this is the question I always have. We deal with a non-linear market. The market is non-linear, period. People try to apply linear analysis to a non-linear market, and it just does not work. So my question to them is always, how do you apply a linear timing frame to a non-linear environment? And I have never gotten a satisfactory answer to that. So to that extent, folks, I cannot tell you there's anything specific on quote unquote timing.
Fantastic. Looking at the big picture for a second, with a historical viewpoint, what does the U.S. economy, global economy, and life in general look like in, let's say, 15 to 20 years when the major pullback recession hits?
Like I said, the US economy, going back to that 100-year chart again, if you remember that bigger paren Roman numeral 2 ushered in the Great Depression. We are about to get into, in a couple of years, we potentially are, at least based upon my analysis, we're going to start a time wherein the same degree type of correction is going to occur in the market in the United States. So I would have assumed it's going to be somewhat rhyming with what occurred during the Great Depression. So that's why I keep saying there's potential for a lot of pain to be had. And that's my concern. I don't want to see it. I'm praying that I'm wrong. But I got to tell you, these charts have been too dead on accurate for me to dismiss it. So
Fantastic. Thank you.
That's my answer.
Do you have any thoughts on other commodities outside of gold and silver? Do you believe that we're in a commodity boom?
Again, I'm not going into commodities today, folks. That is a whole other discussion. And I always say each chart has to be viewed upon its own. You know, people look at this chart and say, oh, look, it's moving up with the market, so there must be some correlation. And then the correlation disappears overnight, and they're left scratching their head because they were basing their investments upon this correlation. Folks, all a correlation is when two chart patterns are trading in the same direction at the same time. Doesn't mean they're both at the same degree. That's why when a chart correlation breaks, people are scratching their head because they didn't expect it. I remember back in 2014, I was writing to our members that based upon all the charts I'm looking at across all markets, I'm like, wow, we are about to see a serious dislocation across all markets, and you're about to see a ton of correlations break down, and it's going to confuse a lot of people. And I remember in probably, I think it was either the end of the first quarter or the beginning of the second quarter of 2014, Morgan Stanley came out with an article saying, wow, we haven't seen a correlation breakdown this severe in over a decade. So, you know, understand what a correlation is. And if you really understand what a correlation is, you really won't be looking to one chart versus the other. You're going to be looking at each chart on its own and making a determination as to what you want to do about each chart on its own. So if you're asking me about commodities, I'm telling you, I need to look at each chart on its own to give you a proper analysis. I don't correlate one to the other. So are the commodities in a boom? Well, I mean, gold has got to get off its horse, and GDX has to get off its horse for me to believe that. But right now, I have no comment about that.
Excellent. Right now, do you prefer growth stocks or value?
You know, I have never, ever looked at the market between growth and value. Again, I look at it based upon its chart. You give me a good chart, I'll invest it. I don't care if you want to label it growth, you want to label it value. I don't care what you label it. I am not one for labels. I don't care if you label something inflationary. I don't care if you label it deflationary. I don't care if you label it growth. I don't care if you label it value. If you give me a solid mathematical analysis of the chart, that is what I will invest in. That is it. Give me a solid mathematical analysis of a chart that I can have risk management, an appropriate risk management perspective. If I'm going to invest in that chart, that is what I will invest in. If it's a good chart with a good risk management opportunity, that's all I need. I don't need to label it growth or value.
Fantastic. Thank you. One of our viewers writes in, Avi, you are recommending going into cash after reaching 4,900. Do we have that correct?
No. You do not have that correct. I said when we are approaching 5,500 is when I probably will be heading into heavy cash.
Thank you very much. Our next question is, oftentimes I miss out on wave 5 extensions by cashing out early. Any way to detect the wave 5 might be extending?
Yeah, a lot of it is usually based upon waves 1 and 2 of that fifth wave. You do your projection for wave 3. If wave 3 just continually extends, then you know your overall fifth wave is going to extend. So you really base it upon your third wave, but then you still have to worry about a fifth wave truncation, because oftentimes, you know, a fifth wave truncation occurs when wave 3 has gone too far too fast. For me, again, that brings me to the point I just made before. That is why when we get up to here, guys, I'm going to start going into major cash positions. Why? I'm not assured that this rally is going to get significant extension over where we are here. And maybe it turns into an extended blow off top. I'll know based upon the wave 1, 2 of this fifth wave, and that'll give me time to get back in again. But I'll tell you, if the 1, 2 is very small, we may not extend beyond much over 5,500. I'd rather play it safe, and that's why I'm hitting 5,500. To give you, for those that are familiar with Elliott and those that follow me, you would know I have a methodology wherein I invest. For example, I like to start buying. Let me take a step back. Corrective structures take ABC pullback structures. The C wave of that ABC pullback, that final wave down, often is a 5-wave structure. I will start buying into the bottoming of that C wave as we're bottoming out in wave 3 of that C wave. Why? Because sometimes the market does not give you that 4-5. Sometimes you'll get an unorthodox bottoming in a WXY. Again, that's a little technical for those who don't understand Elliott wave. But from my own experience, I start buying into the bottoming at wave 3 of wave 5. For that same reason, I start selling at the top of wave 3 of wave 5. I can always get back in after wave 4, but I start selling most of my positions at the top of wave 3 and wave 5, the exact same reason.
Thank you very much. Our next question is, what happens if the pivot fails and we go further down?
Well, then I will have to reassess. But right now, I see nothing. I mean, that's where you stop out and you reassess. But right now, I see nothing that is telling us that we break down below 4,000 here. I mean, a little bit below 4,000 to about 40.50 is probably the bottom of our support here. The wave 4 of 1 lesser degree, which is about 40.50. I'm really seeing nothing here that is telling me that breaks. If I did, I'd consider that. But right now, I'm seeing nothing. I mean, are we expecting a crash like we saw in March of 2022? How often does a crash like that happen? I know recency bias has everybody fearful of it. But historically, you have to look at the norms. Historically, you don't get a crash like that every 2-3 years. It doesn't happen. That's not the way the markets work. So when I look at us being in such an oversold condition, hitting support, completing what looks like an ABC pullback, over the next week or so, I don't have anything that's indicative that we're going to break support.
Excellent.
By the way, I also want to make a point. There are 2 things that you could look at in the market: what is possible and what is probable. There are many things that are possible, but we try to identify what is most probable. And it's possible we break, but I don't see that as being most probable.
Thank you very much. Our next question is, can you provide some thoughts on a potential USD devaluation versus global currencies due to the debt and continued monetary easing? How would it impact equity values? Does equity and maybe real estate become the fortress where capital gets stored so markets go up much further than projected to 2024 guidance?
Okay, I'm going to take you guys back a bit. For those that don't know my personal history, I am an accountant. I passed all 4 parts of the CPA exam. I'm a lawyer. I went through an LLM and tax program at NYU. I was a lawyer. I was a partner. I was a national director. I have been involved in very large transactions that I spearheaded and put together. I understand the fundamentals of businesses. I understand how businesses work. I understand business valuations, and I understand business models as well as business financials. I have a lot of experience in it. I started my career in investing as a fundamental analyst. And I will tell you, I gave it up once I found this. Once I found this, I realized how much those exact questions, those exact type of thoughts would get me looking the wrong way at exactly the wrong time. So if you guys are going to ask me a question about the dollar versus this and versus, I got to tell you, everybody, I'm going to give you an example. everybody assume quantitative easing from a fundamental standpoint is going to kill the dollar, just destroy it. If you bother looking at a dollar chart, you know what? Let me pull up a dollar chart and see if you guys can see it. I'm going to pull up, hold on. I'm going to pull up my long-term monthly. There we go. And I even noted it here. Back in 2011, dollar was what, about 73 or so. And I said that I am looking for a rally in the dollar, a multi-year rally in the dollar that should go north of 103. 103 was my target. Why? The 1618 extension. This is where I was back in 2011, and I made a market call, and I said, I'm looking for the dollar to rally from 73 to 103. What was going on at the time? Quantitative easing. Let me ask you a question. Does it look like quantitative easing did anything to the dollar? If you look at this, you look and say, well, maybe quantitative easing pushed the dollar higher. Does that make sense? No. Quantitative easing had no effect on the dollar. It matters not. That's my point. When you look at a chart like this, folks, and you tell me, did quantitative easing matter? No, it did not. So I have abandoned that type of thinking many moons ago, and it has been much more profitable for me to look at the market otherwise. So I'm not specifically answering your question, but I think you're getting the gist of my answer.
Excellent. Thank you very much. Can you please explain the relationship between EWT and MACD analysis?
We utilize technical analysis to assist us in our analysis of our wave degrees and our wave structures. So, whereas, most people complain and have been turned off by Elliott wave analysis because they view it so subjective and the analysts are always so wrong and everybody comes up with different answers. Well, a number of years ago, I had the same problem with it, but we created something called Fibonacci pinball, and it gives the market much more structure, and it tells us early, are we at the right, or do we have the right pattern? Do we not have the right pattern? And we coupled that in addition with technical analysis and utilizing various forms of technical analysis to substantiate or tell us maybe we may be wrong here based upon what this analytics are doing. We could be off here. Let's take a look at this. We utilize all these different things. We utilize standard Elliott wave analysis. We use our Fibonacci pinball, and we utilize standard technical analysis. We bring all three of those together when we are able to identify a high quality Elliott wave analysis. And that's why, many people ask me, how are we so right when so many people are so wrong? We utilize all these methodologies together. And when we have a confluence and everything is working together on multiple timescales, that's why we're right so often. We're not always right, but that's why we're right so often, because we do a lot of detailed work to get there.
Excellent. Thank you very much. Let's jump to our next question. Avi, what do you see as the long-term structure of EEM in 10 years?
I wrote an article about this last year for our members, and I'll tell you, I'll show you my long-term chart on it. That's my long-term chart on it. And people look at this and say, oh, I should buy EEM now and just hold it for the next 20 years. Not really. What I'm seeing is, yes, the EEM could have more potential than the SPX, because I do have it potentially going higher. But the issue is, I think during the periods of time where you're going to have corrective pullbacks, drops on the S&P 500, and I'll show you what I mean. Let me line it up for you so you can understand. For example, when we top out, I'm looking for a big A wave drop, and then I'm looking for a B wave corrective rally, then another C wave drop for a bigger A wave, and then another B wave corrective rally. But when we go over to look at the EEM, well, I'm looking for a big rally till we complete hour rally on the S&P 500. And then I'm looking for, when the A wave occurs on the SPX, I'm looking for a big pullback in the IWM. Thereafter, I'm looking for a B wave corrective rally on the SPX, and there is potential for the EEM to then outperform during that period of time relative to the SPX. So is it a buy and hold? Not necessarily, but there is potential that the EEM can outperform the SPX during these corrective bounces. Now, that being said, there's one more caveat. While the EM chart looks so much more bullish, I have to tell you, we have a world markets analyst, Garrett Patton, and Garrett told me that not all the world markets that support the EM really line up in the same way. So there could be some dislocation based upon the ETF, but I will tell you, there is potential for the EM to outperform the SPX during those corrective rallies on the S&P 500.
Thank you very much. Avi, we are just about out of time. I think at this point, the whole audience would really appreciate kind of a recap of your thoughts here on the webinar before we wrap up.
I'm going to make it simple. I'm going to go back to the daily chart. As long as this market pivot holds, folks, I'm looking for 4,900 as we look towards the first quarter of 2022. Pretty simple. I mean, where am I looking for 2021? I'm looking for us to be bottoming out in this, I don't know, over the next week or two, maybe. And then I'm looking for a rally to begin into year end, potentially extending into the first quarter of 2022. My ideal target right now is the 4,900 region.
Excellent. Avi, it's always a pleasure to have you here at the Money Show. We've had almost a little over 1,000 people join us for this session. Just a fantastic turnout, great insights, and we really, really appreciate it. Thank you so much for your time today.
Thank you so much for having me, and I thank everybody for joining me, and I hope I was able to give you a little bit of not just projections, but also understand where our risk management points are. That 40, 50, 40, 100 region, that really is the bottom of your support right now. So you now have a perspective from, with a good risk management plan in play as to how you can maybe able to glean, 600 points higher with maybe 200 points of risk.
Excellent. Great closing remarks. Thanks so much, Avi.
Thank you. Have a great day, everybody.
You as well.